Hello, this is Huskins, the Forex Mentor. Welcome to another phenomenal day in the markets today. Your daily review for April 9th and the preview of April 10th. Your dose of events that shape the Forex markets. This is what Margaret Thatcher said being powerful is like being a lady. If you have to tell people you are, you aren't. Our results Swiss CPI yields in painless 25 pips. Let me share that with you really quick. All right, so this is what our trade was. Let me just pull it out. At 315, we sold right from these highs, and then we went about getting our easy one directional 25 pips right here. And if we'd held on without it going up to break even, we would have easily made 50 pips. But I'm going to record this at about 25 pips, which was the initial target, not the 50 pips which we would have made, because I personally would not hold my position so long. So 25 pips it is. Now, uh, talking about the Swiss trade, we just looked at what the Swiss trade was, but the Swiss um, inflation was weaker than expected in March. Now, data showed on Tuesday, underlining the central bank's view that a lid is needed on the franc. Prices fell 0.6% from a year ago and rose 0.2% from a previous month. Now, this is where I'd like to share with you where I differ from the majority of the forex world. Based on this particular news that Swiss inflation was weaker than expected, the knee-jerk reaction normally of most traders is that the Swiss franc is going to go weaker and we need to buy the USD CHF because the CHF is the second pair. So if I'm betting on the Swiss franc becoming weaker, I'd want to buy. So while the entire forex community was actually buying, I was actually selling and reeling in my profit. Now, why does the CPI act differently? First of all, let me talk to you about what does the rest of the world think. The rest of the world thinks that worse than expected CPI means that the government's not going to raise interest rates. If government is not going to raise you know interest rates, then that currency is going to get weaker because the money goes to the place wherein it's served with the highest interest rates. So that is what the normal philosophy is, and that's why out here the rest of the world was actually buying. But let's see what the smart money was looking at. Smart money, such as us, we knew better than that. We knew that when their inflation is good only in certain contexts, good for the currency only in certain contexts. Most of the time, a higher than expected inflation number is just depleting the purchasing power of that particular country. In this particular case, the Swiss franc. And a lower than expected inflation number is giving more strength to that particular currency. So people in Switzerland can buy more with their Swiss franc than what they would have had the inflation number been a lot higher. So, in my opinion, in um, in this particular case, we should have bought the Swiss francs, so sold the USD CHF, and that's how we yielded our profits. Yes, there are certain circumstances wherein I will go with the majority of the world decision, and I'm going to let you all know about that well in advance, when we need to be a contra player and when we need to follow the herd mentality. Right now, it was the time to be a contra player, and that's how we made our 25 pips. Okay. Now, another flashpoint which I'd like to discuss with you is that record first quarter inflows push ETF assets to 2.09 trillion range. That's a trillion with a T. All right. Now, net investments in the exchange traded funds and other exchange traded products total 73.4 billion in the first quarter, setting a record according to the report by the research firm ETFGI. The total invested in exchange traded products globally reached a record 2.09 trillion, the report says. Now, why am I bringing this up? First of all, is um, what are ETFs? ETFs are exchange traded funds. Basically, you have managed funds and then you have exchange traded funds, um, which are like which are similar to, let's say, uh, managed funds, but with a lower transactional cost, because you don't pay a manager to manage them. So, what would an exchange traded fund be like? Okay, an exchange traded fund might say, okay, we are procuring gold and holding on to gold, or we will, or the funds only management or entry into the market is to do one particular set. It's very simple, not very complicated. So why is this very important? Is that right now we see run up in the markets. Is the markets based on a true run up, or is it based on a false run up? Had it been on a true run up, we wouldn't find ETFs increase in value so much. Since it is a false run up, we are expecting a crash. But is the crash right now, or is the crash eventually? I've always maintained that right now is not the good time for a crash. But just to let you know that these are sure cut signs that the stock markets are being inflated artificially by money knowing not knowing anything better to do. Money is not investing being invested in real businesses. They are in being invested in speculative ETFs, and eventually that needs to turn around. Okay, now European government bond yields reach a record low. Now, what does this mean? It means that the bond prices increase the most, and that is why the 10-year government bond yields of France, the Netherlands, Austria, Belgium have fallen to lows. And why is that? Because Japanese institutional investors search for higher fixed income yields. B- Okay, the story is Japan is gone berserk and they're going to keep on printing money, 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 money. Now, all this money has to go in somewhere. So, they are, the Japanese are very fond of interest denominated investments. So, what happens is that one of the places where they've invested money is the European government bond yields. So, why does this come about? Is that when the next crash actually takes place, the the money where which is being inflated, or the places which are being inflated will be the places which will crash first. All right. So it is just it is very important to know which are where is the money coming from, and where the inflation of that extra printing of money is going towards. Now, regulators institute programs to reduce market volatility. Right now, the market volatility is very high, and regulators they would need to do something. So, what they're doing is they want to have a band on US shares that it will not trade above this or below this. Regulators are also testing fresh restraints that will suspend stock options and index futures should the S&P 500 index dive. Now, both programs are set to run for 1 year. Now, preview for next week. Let me pull that up really quick. All right, so we have, let's look at the red ones really quick. We have trade balance from China. I don't have a trade plan on that. We had a trade plan on FOMC minutes, but it's no longer valid. But this is definitely something which I'll be observing. And we have a trade plan, which is a green trade plan for Aussie employment change. So we could be looking to trade that. So I'll just pull up our little members only page. So FOMC minutes and the US federal budget balance we'll be looking at, but we will not be trading, but we will be trading the Australian employment release. That's it, guys. Talk to you tomorrow. Have a wonderful day. Bye for now.